All right, let's jump right in. Today we're going to tackle two incredibly powerful option strategies for when you think the market is heading up, the bull call spread and the bull put spread. Stick with me, and by the end of this, you'll know exactly how they work, how to figure out your risk, and most importantly, how to use them to trade smarter.
You know, what's the #1 fear for just about every options trader? It's that unlimited account-destroying loss, right? You sell a naked option, go to bed, and some surprise news hits overnight. And boom, your position is bleeding out. But what if? What if you could put a hard cap on that risk before you even click the buy button? And this slide right here, this shows you the whole story. On the left, that's the world of naked options. It's high stress, it's unlimited risk, and it demands a ton of margin. But over on the right, that's the world of spreads. Your risk is totally defined, your margin is way lower, and you have a controlled outcome. You know your absolute worst-case scenario from the get-go. It's really the difference between pure gambling and strategic trading.
So what exactly is a spread? Well, in the simplest terms, you're just buying one option and selling another one at the exact same time. Now, they have to be for the same stock or the same index and have the same expiry date, but here's the secret sauce. They're at different strike prices. That combination is what creates this amazing, defined risk structure.
Okay, let's get into our first strategy, the bull call spread. I like to call this one pay-to-play with a safety net. It's the perfect tool when you're feeling moderately bullish. You think a stock is going up, but you're not expecting it to, shoot to the moon. This is what we call a debit spread, which just means you pay a little bit up front to get in on the action.
So how do you actually build one of these? It's a really simple two-step dance. First, you buy a call option, usually one that's at the money or pretty close to the current price. That's your main bet that the price will go up. At the same time, you sell another call option with a higher strike price, something out of the money. Selling that call brings in some cash, which helps reduce the cost of the one you bought. The final result, a net debit, a small cost to open the trade.
Now, this is absolutely crucial. This is a non-negotiable rule, so listen up. For a spread to work, both the option you buy and the one you sell must be on the same stock and have the exact same expiration date. No mixing and matching, ever. And here's where the magic really happens. Your potential outcomes are all defined by simple math. Let's walk through it. Your maximum loss? It's capped at the net debit you paid to get into the trade. That's it. It can't get any worse. Your maximum profit is the difference between your two strike prices minus that debit you paid. And your break-even is just the lower strike price plus the debit. See? You know every single possible outcome before you even risk a single rupee.
All right, moving on to our second strategy, the bull put spread. Now this one's a real game changer. It's a credit spread, and that means you actually get paid premium to open the position. It's an amazing strategy for when you're feeling bullish or even just neutral to bullish on the market.
So, how do we put this one together? It's pretty much the opposite of the call spread. First, you sell a put option that's near the current price. That's how you collect that nice premium. But to protect yourself from a sudden drop, you then buy another put option but at a lower strike price. Think of this cheaper put as your insurance policy. The result of all this is a net credit. Cash flows directly into your trading account the moment you open the position.
Okay, let's quickly run the numbers on this one. Your maximum profit is super simple. It's the net credit you received right at the start. If the stock just stays above your sold strike, you get to keep all of it. Your maximum loss is the difference between the two strike prices minus the credit you already pocketed. And the break-even point, that's your higher strike price minus that net credit. Again, everything is perfectly defined, no surprises.
You know, the mindset here is totally different. With a bull put spread, you're not betting on how high the market will go. Nope. Instead, you're making a bet on where it won't go. You're basically saying, I'm pretty confident the price is going to stay above this specific support level until expiry. And if you're right, you win.
Okay, so we've got two bullish strategies, the bull call spread, where you pay to get in, and the bull put spread, where you get paid to get in. They both like it when the market goes up, but believe me, they are very different beasts. So the big question is, which one should you choose?
This table really lays it all out. With a bull call spread, you pay a debit, so you really need the market to move up to make money. And time decay, or theta, can actually work against you if the stock just sits there and does nothing. But with the bull put spread, you get a credit up front, and you can win if the market goes up, sideways, or even down a little. And here, time decay is your absolute best friend. Every single day that ticks by, the options lose value, which is exactly what you want as a seller.
Now let's talk about the single most important part of this whole explainer. You can have the best strategy in the world, but without discipline, it's useless. Remember, limited risk does not mean zero risk. These are the rules that will keep you trading for years to come.
These three rules separate the professionals from the amateurs.
First, position sizing. Please never risk more than 1 or 2% of your total trading capital on a single trade. This is how you survive. Second, plan your exit before you enter. You need to know your profit target and your stop loss before you even think about placing the order. No emotional decisions mid-trade. And finally, be smart about your strikes. Don't just pick them randomly. For a bull put your sold strike below a solid support level. For a bull call, aim for a realistic resistance level. Be a strategist.
So, I'm going to leave you with this one question. Now that you know about these structured, risk-defined strategies, what are you going to do? Are you going to keep buying those out-of-the-money lottery tickets and just hoping for a miracle? Or are you ready to start trading like a real strategist, with a plan, with controlled risk, and with the probabilities on your side? The choice, my friend, is yours.